Good morning, ladies and gentlemen. My name is Jane Lin, and I'm the Chief Investment Officer at Alpha XRE Capital.
Good morning. My name is Kai. I'm the VP of Construction Architect, co-founder of Apex Homes. Welcome to PRET 2024.
We loved it so much last year, and we think that we have to really bring it back this year.
Thank you for spending a Saturday with us.
This summit aims to provide a platform for all of us to learn and shine on the most trending topics in the real estate world, to deeply connect with this land of opportunities. Everybody knows where it is, right? The Silicon Valley. By merging the forefront technology into the traditional real estate world.
And what we're trying to do here is to create a vibrant and diverse community in real estate in Silicon Valley here. And we want to bring everybody here together to help each other, to support each other. And for those that are just getting started and for those that are already super seasoned in the industry. So we have a lot to look forward to. So Jane will tell us about all of our sponsors.
Of course, yeah. And first of all, we want to give a huge shout out to every one of you here to support us by coming in on a Saturday morning. Happy Mother's Day, by the way. And of course, to all of you who contributed to this PRET Summit 2024, especially all our sponsors. And they are Anchor Loans, Marbella Lane, First Commercial Bank, A Strategy, Invest Now Capital, Interface Education Services, Chinese American Real Estate Association, Chinese Entrepreneurs Organization, Zetro, Radiant A Lending, Isla Interior Design and Staging, and of course, Access Investment. And absolutely the most important, last but not least, host of the event, Alpha XRE Capital. And thank you so much for your generosity, donating all the proceeds for today's events to the nonprofit organization called Silicon Valley Real Estate Tech. Thank you.
And today we have a lot in store for you. We have an impressive lineup of 7 really insightful panels, and we'll dive deep into the industry, covering topics that are of interest for those that are newcomers and seasoned professionals. In addition, we have 2 keynote speeches throughout the day. So also don't miss out on the opportunity to network during lunchtime with our local mayors, and be sure to explore our exhibition booth in the hallway outside. And we've got lunch covered, so stick around.
And absolutely, last but not least, we have a surprise for all of you. We're actually inviting all of you to become our judges for the last Shark Tank of the Silicon Valley, what we call the special startup pitch competition. So we have invited 5 very promising startup companies, all in the real estate tech world, to give us speeches about their company. And you guys are all invited to be part of the crowd, So stay tuned to the end, and everybody should vote to come up with the most promising startup company in the real estate world today.
All right, so are we ready for today?
Yes!
All right, without further ado, let's welcome our first panel. Panel number 1, our real estate economic trends, what to expect in 2024. A glimpse into trends and future impacts on real estate market. Let's welcome the moderator and the speakers of the panel.
Two graphics in the church, one with love.
All right, you guys hear me okay? Yes. Good morning, everyone. Welcome to our first panel discussion, Real Estate Economic Trends of 2024. We'll be discussing various factors shaping the real estate market, providing insight to potential buyers, sellers, and real estate investors, and telling what they can anticipate in the upcoming months. So my name is Jennifer Young. My friends call me Jen. I'm a partner at Geraci Law Firm. We are the nation's biggest private lender law firm. And I am joined here today by Tom, David, and Elisa. Please introduce yourselves. Just a little background on the company, what you guys do, where you are, anything.
Awesome, awesome. Cool, I guess I'll go first. My name is Tran. We are real estate investors, real estate fix and flippers in the Bay Area. Because real estate is so interesting in the Bay Area. We do residential, we do some multifamily, but mainly fix and flip. So you can ask me anything about remodeling. I know everything about fixing houses, building houses, and asbestos. I am an asbestos expert. Thank you for having me, and thank you for joining so early in the morning. Appreciate y'all coming out.
Yeah, thanks everyone for coming out. My name is Katz. I'm a co-founder at Magnify Real Estate. We're based out of Los Gatos, and we help clients buy and sell multifamily investment properties for apartment buildings in Silicon Valley. We're also on the principal side, and he deals with asbestos. We deal with cockroaches and value add, heavy value add investment properties. So twofold: number one, helping clients buy and sell apartments, and secondly, on the principal side ourselves, managing and growing an apartment portfolio.
Hey everyone, my name is Elisa. I'm a house flipper in the Bay Area. So I'm Tom's competitor, and I've been flipping houses for 6 years now. I've done over 60 projects, and with an average profit about over six figures. I also wrote a book called Flipping Houses Quick Start Guide. It's #1 release on Amazon. So that's how I teach beginners to also get started in flipping houses. I started a coaching program called Transform Flipper Academy. That's where I teach my students the ins and outs about house flipping and also help them achieve financial freedom. I actually have a few students that are in the audience today as well. I really enjoy helping others and educate more people to get out of the rat race, because I came from a 9-to-5 background, and I used to really feel unmotivated by my job, and I feel very stuck at my full-time job. So I want to help more people to get out of that situation and also achieve financial freedom. So I have a YouTube channel where I share a lot of renovation tips and before and after videos of my flips. It's called Transform Real Estate. I have over 80,000 subscribers. So if you guys are interested, you can check it out as well. Thank you guys so much, and I'm looking forward to sharing some insights with you guys today. Thanks, guys. All right, so let's get into it. Real estate market. What are some key factors and indicators that drive the market in general?
Okay, want me to start first? Okay, I'll start first.
Wow.
Awesome. So real estate market, that's something that everyone asks, right? Every single day. How's the real estate market? How's the real estate market? It's a common question. How I would answer that is it's hot. It's always hot, right? So we're sitting here last year talking about real estate market. That was already a hot market last year. We were talking about crazy prices. Areas hitting 2 million, 3 million. Now it just got crazier. So how do you explain that? So for example, a house in Santa Clara that we offered last year, maybe 1.2, 1.3 as is, that same house this year is hitting 1.5 to 1.6. So how do you explain that? A 15% increase, right? 15% increase in 1 year. So what would justify a 15% increase in 1 year? In some cases, 1 month. In some areas, prices are going up 15% in 1 month. So how do you explain that? Economics, people have more money. NVIDIA, I should have worked for NVIDIA, I should retire by now, right? So there are a lot of ways to make money out here in the Bay Area, stock options, things like that. So everyone has money. Everyone has money. Another example is a lot of our buyers, after we fix up the house and sell it, these buyers are coming for cash. So our Water Creek flip, they take 1.8 million in cash. They were the highest offer, and they had the most money. So they had $1.8 million sitting around to buy a house. Does anyone have $1.8 million sitting around to buy a house? I want to talk to you after you do, because there are a lot of people with a few $1 million sitting around. And that is the economy right now. That is the market. That is who's buying houses. So yes, houses are not affordable for you or someone else, but it's affordable for people that have to do it or pay down payments, or in most cases, they can still buy it. Is that long answer? Good, one answer.
Yeah, absolutely. And to that end, what we call that would be the liquidity zone, so to speak, especially for both apartments and for homes. For assets that are under $2 million, there's a ton of demand, especially assets under $1 million. Above $3 million, you start to have less competition, better economies of scale, but that helps explain why some of these smaller asset values in the $1 to $2 million range, despite the various headwinds in both multifamily and residential, they continue to have very, very strong demand. And that ultimately goes back to scarcity and supply and demand. So being in Silicon Valley, we're geographically confined. We've got San Francisco, San Jose, the water and the mountains, and so it's there's not enough land out here. Very different than Phoenix or Austin or other submarkets where they can keep building and building or expanding, or governments that are more business friendly to build more. Whereas in Silicon Valley and the Bay Area in general, there's scarcity of land, and it's also very difficult to do new construction. And so as a result, you have very limited supply, and it's always been that way. We had a client that had an apartment building in Mountain View in the 1970s, very similar environment to today. I wasn't around, of course, but there's very high inflation and a lot of turmoil in the Middle East at the time. And yet, when they bought their property in the 1970s, they said that in the newspaper, they saw it in the newspaper, and to go and tour the apartment, the line was down the street on Colony, wrapping around Middlefield. That was in the 1970s. When they told me that, I realized that the Bay Area has always been very, very limited in supply and has always had strong demand. First off, in terms of the weather, you've got great weather, great submarket. All the major employers are still very much local to the Bay Area, and so in that sense, the investment thesis is very much intact. We'll talk a little bit later here shortly about the various headwinds for residential and multifamily, but the fundamentals are intact with the major employers being here, a great location in the world, and scarcity in supply of housing inventory and from a geographical sense as well.
A big factor that's affecting the housing market here or the whole country is interest rate, and interest rate has been so high, so it really put a constraint on the buyer's purchase power. And when that happens, usually you see prices decrease because there's fewer buyers in the market and there's less demand. But that's not what we are seeing in this market right now, because the higher interest rate also put a constraint on the supply, because a lot of sellers are feeling the pressure, and there's the lock-in effect, because they are currently paying much lower interest rate, and if they were to sell their home and purchase another home, they would have to really trade their low interest rate for a much higher interest rate, maybe 2-3 times higher. So sellers are very reluctant to sell their homes. That's why we're seeing very low inventory in the market. And this limited supply and limited demand caused the price actually holding pretty steady since probably the second half of last year. And since the beginning of this year, we're seeing even a bigger shift in the market, because there's some suspicion that the Fed is going to actually lower the interest rate soon, and a lot of buyers are really worried about more competition coming into the market, so they are actually getting back into the market. So we are seeing a lot more demand than last year, and the prices have been driven up even higher. So it's quite interesting because the market is not behaving like what we would predict if it was like because of the high interest rate, but it's still limited supply, limited demand, and then the prices are not really dropping. So I think it's really tough for home buyers at this time. So hopefully, as the year progresses, we'll see lower interest rate, and then buyers will have more purchase power.
Thank you. Yeah, so to talk a little bit, really quickly on the things and how they can get the memo that was supposed to go down this year, right? So I have some residential transition loans, RTL loan data, especially for the footers and bridge. Nationally, it was up 11.3% in April, and California is at 11.1%. In California, the interest rate varied between 9.6, which is kind of on the lower end in Santa Clara loans, and as high as 11.9 in Fresno. But LA County had the largest county by market share, because the research on transactions in California, and their average interest rate was 11.3. Sierra was 8% in April, and 7.7 for California statewide. How do you guys deal with this? What options are you guys seeing? And what are some challenges you face as you're looking for real estate financing for your projects?
Yeah, good question. Financing is the most important part, right? About buying a house, or we're fixing or flipping or investing. So just a year and a half ago, we were getting hard money loans at 7.5% interest only. Going back to quarter four, our home buyers, first home buyers buying a house, their rate is 7.5. It's the same rate as hard money. Is that crazy? So the hard money rate is used to be the same rate as it is now, but now hard money is up to 9%, 10%, just like you said, 12%. 11%. So in smaller price markets, Fresno, Sacramento, you're getting 12% interest rate, and that is normal. Now that's very normal. So our 7.5% fixed flip rates are long gone. We're never going to see that again. Home buyers are willing to pay 7% right now for a regular 30-year conventional loan. So that's become normal. So the new normal is actually very expensive. Right? The new normal. What is the new normal now? New normal is $2 million for a decent house in a nice luxury area, right? Santa Clara, Campbell. It's $2 million at a 7%, or the lowest maybe 6.5%. So that is the new normal. So that's a hard pill to swallow. You have to pay $10,000 a month to live in a luxury area. $10,000 a month, right? So it's tricky because interest rates are always going to be high. Will the interest rate drop? I hope so, but from 7% to 6%, is that still expensive? I think that's still expensive, right? So no matter what, interest rates are going to be high. This is the regular dynamic, and it's always going to be that way, and people are still going to pay $2 million for a house at 6%. So yeah, it's pretty the way it is.
You know, what's interesting too is that historically, interest rates are still relatively low. But specific to what we've all gotten used to in the last decade, interest rates are very high. And you know, in apartment buildings, high level, the returns that we've been selling for the last 7, 8, 9 years, we've been selling buildings that will yield a 4 to 5% cap rate. And it made sense when people were borrowing at 3.5 to 4%, because people could at least break even on every dollar they were borrowing, or make money on every dollar they were borrowing. Whereas that script has been completely flipped in the last 2 years, where I think a lot of people were still investing in real estate. It's great hedge against inflation, and asset values continue to hold their value or go up. But the longer that these higher rates are settling into the market, the more and more buyers are fearful, and lenders are willing to give less loan dollars. So that's been a big problem that we're dealing with on all of our listings, even in trying to refinance a number of buildings in my own family portfolio, is that the expectation that rates will drop 3, 4, 5 times in the next 6 to 12 months is dissipating, and it seems, as the Fed has said, that rates will be higher for longer. And from an economic perspective, this is concerning because if rates are at 4 to 5, if the returns are at 4 to 5%, but rates stay elevated, even if they drop from 7% to 6%, you're still going to need to see the return for apartments as investment property. You're going to need to see that return go up, which means either rents going up or expenses going down, which isn't happening. Utilities are only getting more expensive, if anything. And so, what we have there is a very difficult operating environment when it comes to interest rates and financing. We've seen more cash buyers coming into the fold, more experienced investors that are doing hard money loans or bridge money loans, where the underlying asset is exciting for the investor and the lender. And so those are easier to get now, to get a bridge or hard money loan as an acquisition. But the takeout loan to refinance is much more difficult right now. And lenders are being very conservative with the loan dollar rent. So the longer that rates stay higher, I think the more that we're going to see the lock-in effect wear off. As she had mentioned, anyone right now that's sitting on a mortgage that's under 5%, they're holding it. It doesn't make sense. Especially if it's a residential loan that's fixed for almost 30 years. And so that helps explain the drop in supply, like she was explaining. And at least in apartment buildings, the max, most loans are usually only 5 or 7 year fixed terms. And so in the coming year or two, you probably read a lot about the $1 trillion in commercial real estate debt that's going to come due for refinancing. And I think that's when we'll start to see values start to drop as people have to refinance at these much higher rates.
So in the house flipping business, the impact of interest rate is twofold. So on the purchase side for house flippers, it's harder to get loans and it's more expensive to hold on to properties because of higher interest rate. And then when you are ready to sell the houses, because of higher interest rate, the demand, as we talked about earlier, is constrained and buyers are more hesitant to purchase homes. So we are seeing a lot of buyers, really they love the home, but they are thinking of the high monthly payment and they are very hesitant to make the move. We're hoping that with the interest rate hopefully going down later this year, then the buyers will be able to feel a little more at ease. But then again, there will be more competition because more buyers will be ready to get into the market. So it's a little bit tricky right now.
So how are you guys financing your deals with the higher interest rates? What are your options? What works for you guys as far as financing, your projects?
So we're still buying with hard money since that's our only option.
Yeah.
So if the rates go up, we can't just stop buying houses. So we just have to keep on buying houses at a higher interest rate. And because we're buying at a high interest rate, then we're hoping to sell at a higher price. So it comes down to the buyer is taking the biggest hit because they're paying the highest price for our finished product because we pay high interest rate, which the bank charges more high interest. So at the end of the day, the consumer is the one that hurts the most because they're paying a premium for their housing to live in the Bay Area. Going back to the $2 million average, as unheard of, $2 million for a decent house in the Bay Area. Even 1.5 million can only get you so much. Even Milpitas, everyone was complaining, Milpitas is the stickiest town in the Bay Area. So if the stickiest town in the Bay Area can hit 1.5 million, what is a good smelling city can hit? 2 million. So it's just a crazy market.
So you guys, how are you financing your deals?
Yeah, right now we've seen a shift away from some of the major lenders. First Republic obviously did a lot of financing in Silicon Valley. They're now with Chase. Chase has generally been more conservative in giving loan dollars, and so we've seen a shift, for our clients and ourselves towards more boutique firms when it comes to takeout loans. As mentioned, when it comes to the pre-issued loan or money loan, getting into the deal, if it's a great deal, the money's there for financing. But very, very challenging on the back end, to go back to the bank and refinance. And it used to be so easy with First Republic and with low rates. And now we're seeing values get crunched down on refinance. You might come in and spend all this money remodeling, and maybe you could sell it for a big price on the open market, but the bank will only, or the appraiser will only value it, 10% below that. So it's very challenging, but I've seen a shift toward more boutique and lesser known, firms that are perhaps even out of state, instead of, the regional banks that were dominating the lending market for the last decade.
So like Tom said, we're still using hard money loans a lot, but it's really important because the interest rates are fluctuate at this point. So it's really important to shop between different lenders to find the best rates available. And also, we are trying to leverage private money a little more because compared to the higher interest rate hard money loans, private money loans can be more affordable in some sense because to an average private money lender, like just a wealthy individual usually, their other options are to invest in the stock market or put their money in the savings account, and they don't really yield a lot of money, or the risk is a lot higher compared to investing in real estate. So a lot of times they still prefer to make a higher interest rate than what they would get from a savings account, but have less risk to invest in a real estate deal compared to in the stock market or in crypto.
All right, let's shift a little bit to real estate buyers and investors preferences. The housing market, and their over the recent years, what are some trends that you've been seeing? What do you expect to see this year?
Yeah, so we can break that down to what homeowners want and then what investors want. So homeowners, they still want the same product, open kitchen, landscaping. Landscaping is a huge part of homeowners' desire, right? You want a nice backyard where your kids can play. Good schools is always number one. They always say, where are the good schools? Open floor plan. But now, buyers are becoming less picky. It's not about the size of the house anymore. People are willing to buy a 1,000 square feet house in Menlo Park for $2.5 million because that's all they can afford. So it's not even about the size anymore. So size doesn't matter anymore, but other things matter, such as the kitchen, the backyard, things like that. Flip that to the investor side. Investors are a little bit more picky when they get into a flip because it's harder to finance. Hardware lenders, go back to financing, hardware lenders might require 20% down now versus 10%. So everything that we buy is just a little bit harder than before. So as investors, we buy less remodeling, less ugly houses, less crazy repair. But because inventory is so low, everyone's still buying everything. There was an article for the meth house in San Jose. Did anyone see that meth house? Did anyone make an offer on that meth house? It was listed for 1.4 and it went pending. And let's see how much it sells for. So even a meth house can sell in the Bay Area for 1.4 million. Isn't that crazy? So anything can sell in the Bay Area because it's just a competitive market. There's no inventory. So going back to your question, what is buyer's preference? Anything. Anything that looks like a house in the Bay Area. Even a shed, they'll probably buy it because you're living in the Bay Area.
Yeah, and also in the Bay Area, especially core Silicon Valley, the investment thesis is still intact, where You may have seen where maybe Tesla moves their headquarters or a couple of companies left. At the end of the day, all the major technology companies are still located in the core Silicon Valley. NVIDIA is the opposite of us, very close to here, less than 10 minutes away. And so I think that's part of what's driving the value globally. I think after COVID, we saw a shift away from the urban core and more towards lower density suburbia, as I would call it. And Silicon Valley or Menlo Park, these are such desirable and great submarkets where you have strong demographics, a lot of great employers that are very local to the area, and it's in line with the shift away from people wanting to be in a very dense high-rise in downtown San Francisco, and towards people wanting a little more space to spread out, have a dog, family, etc. So I think the Bay Area is well positioned there with a lot of submarkets that are quaint and very nice. And in terms of multifamily apartments, people want apartments to be as close as possible to a single-family home. So when we're investing in apartment buildings, one thing I'm always looking for is, can we fence in patios? Can we cut this window and turn it into a sliding door to create a backyard? Can we take this hallway closet and add a washer dryer? So some of those amenities that make an apartment as much as possible like a home, single story, backyards, washer dryer, those types of amenities is what's driving value in multifamily.
So for homeowners, or home buyers, we're seeing people really like move-in-ready properties. Because of the high inflation, home buyers are worried about or are scared about having to do a renovation or some work on the properties. So they are more drawn to the properties that have already been remodeled. So, which is good news for us house flippers. And I agree with Tom that people are definitely looking for more backyard space, more backyard entertainment options. So if you have an outdoor kitchen, you have a big lawn, you have putting green, then buyers really like that. And for investors, because of the higher interest rate environment, we are very strict with our underwriting. So we want to make sure all the deals are solid before we move forward. And we also we want to make sure that the deals we get don't have any big flaws, like homes that are on busy streets or close to the freeway or close to commercial. So I try to stay away from those because those properties with big flaws may be hard to sell in this environment.
ADUs, I'm curious, because I'm personally looking for ADUs, right, for my aging mother. And I know that a lot of like companies are actually coming down funds out there and they're only focusing on ADU lending to buildings. And is that something that you guys see like the pockets or specific geographical location to it's more popular? You have space up on the city of that place.
Yeah, I think in general, ADUs are extremely popular, especially in the most premium submarkets. If you've got a building in downtown Palo Alto, you can add an ADU, whatever it takes, it's going to be extremely worth it. If you're in East San Jose, maybe not so much. So I think the location is important because it is quite a hassle. I've done an ADU conversion for a building in Redwood City, and it was quite difficult. And I think it goes back to the product type. If you're taking a home and adding an ADU, much more straightforward. You're not gonna. It's going to be quite easy to work with the city, and highly recommended. Whereas if you're taking I took a fourplex and added a unit, turned it into a 5-unit. Learned a lot through that process, and we ended up having to fire sprinkler the building, bring it up to code, upgrade the electrical main panel in order to turn everything, to electrify everything. I was able to stack some various government rebates as well. If you're doing any of these projects, I highly encourage you to take a look at various programs like Tran, openness of clean energy, because they'll help subsidize turning from gas to electric. But in the case of apartment buildings, it triggered a lot of regulation. So not as worth it, whereas in homes, you can pretty much just add a kitchen, add a bathroom, and you don't need a dedicated heater. It's much more straightforward and highly recommended for homes because people want that multi-generational living. And that's what's going to continue to drive value in a sub-market that's very supply constrained, is if you can have your home plus a unit that you can either rent out to help pay for the mortgage or have a family member there or yes. So ADUs, especially in premium locations, are highly recommended.
I agree that properties with an ADU are very popular among buyers because of the purposes or the reasons that David has stated. But I also find from an investment perspective, I don't know if I would ever add an ADU onto a property because of the time that it's going to take to get permits and also the high building cost. I find buyers not really willing to pay a premium or a much higher premium than what we pay as the building cost for properties with an ADU. So when I flip houses, I don't really look for opportunities where I can add an ADU.
Okay.
Yeah, so to add to that, that's a perfect point. As an investor, we don't want to lock up ourselves into a long-term project that ADU is going to take us a year, maybe a year and a half. So as an investor perspective, ADU doesn't make sense to us as a flipper, but as a homeowner, it might make sense because $300,000 or $400,000 to build another house and you rent it out for $3,000 or $4,000 makes sense. You get 1% return, right, on your investment. Now, when you sell it, just like Lisa said, buyers don't want to pay a lot of money for that extra ADU, so you don't get that money back. Sometimes you might get some of it back, but you're not going to get like triple return of what you put into that property, right? Because some people don't want to rent out their backyard to someone they don't know, or some people don't want to live with in-laws. That's a perfect excuse to not live with the in-laws. I don't have an ADU, you can't live with me. So ADU doesn't have that much value. But now, new construction, we're seeing a lot of new construction at ADUs because you're already building a house. You might as well build another one right next to it. So we see a lot of new construction, Palo Alto, have ADUs. So it's I guess it depends. It all depends on what is your goal and purpose with ADUs.
Well, let's quickly touch base on rising property insurance. We're all experiencing it, we're seeing it, has a steep how bad is it really, how we're mitigating this.
Yeah, that's really interesting because we just got a letter from our insurance company saying that they're going to cancel our insurance because there's cracks in the driveway. So that doesn't make sense. So all the insurance companies are making it harder to get home insurance. And they went to shop around with a different company, and then the insurance rates goes up. But similar to interest rate, what choice do we have? We don't have a choice. We just have to pay more. So home insurance used to be under $1,000. Now home insurance is averaged $2,000, right, for most houses now. But it's just the cost of owning a house. We just have to set that up.
Yeah, in multifamily, we've seen insurance premiums literally double. In some cases, nearly triple in the last 3 years. And it's been very, very difficult to deal with. I have spoken with some insurance providers that said in a year and a half, 2 years, companies, as rates drop and the economy improves, these insurance companies will get back to wanting to grow. Whereas right now, they don't even want the business, which is very difficult. Same thing, I'm getting cancellations on insurance, age of construction, there's no way around it. State Farm, Farmers Insurance, they pulled out of California entirely. In some cases, the age of construction cutoff is like 1990. And a lot of the Bay Area for homes and apartments was built out in the 50s, 60s, 70s. So this is a major issue right now that owners are dealing with. It also creates opportunities for investors as well because people that have owned a building for a long time and all of a sudden their insurance triples, some of those sellers are now starting to say, hey, let's reposition the equity because the premiums are becoming very difficult. And especially when it comes to older electrical, like a couple brands like Cisco and Federal Pacific on every apartment building that we're selling. It's a big issue to place insurance, and something that everyone has to deal with right now. And if the situation stays like this, then it'll put downward pressure on values in the coming year.
So luckily that insurance cost is not the highest cost or even nearly the highest cost in the home renovation project. So it's not affecting our business as much. But I highly recommend if you are looking to get insurance, you want to get multiple quotes from different providers so that you can compare the quotes, because there can be a huge difference between different insurance providers.
Thank you. About 5 minutes left. I just want to touch up on, since we're here in Silicon Valley, how is tech playing, a role of tech playing in the real estate market in 2024? I mean, we have AI, we have Proptech platforms, VR, even for seeing potential markups of, what the rehab project's going to look like. How does that, do you guys use technology? What does that look like? Can you speak a little bit about that?
Yeah, in general, there's a lot of great tools that are becoming available. For example, one that we just stumbled upon this week was a 3D scanner where, we used to pay a company $1,000. 5 years ago, we paid a company $1,000 to come and give me the floor plan and take aerials, and now you can scan it with an app and get your floor plans. And I just use that to submit for a permit without having to go and pay an architect for drawings. So that's one example that's really streamlined the permitting process, and when we're posting our units for rent, we're able to give a floor plan without paying a lot to do that. Obviously, I think using Bard or ChatGPT when it comes to market our properties, or even coming up with a strategy of how to canvas the market, that information is becoming very, very easy and at your fingertips to leverage. So there's a lot of great things also from a design perspective. I know Redfin just came out with a feature where you can say, hey, I want to see this photo or this listing for sale. What does it look like with modern finishes? And AI will generate an image to give you exactly the look that you're looking for, and then you can go to a Wayfair representative and have them match it. So some of that type of technology is definitely making it easier for the average investor to maximize returns.
To piggyback on David's point, I've been using AI a lot in interior design and landscaping design. So you can upload a photo of an owner or a fixer-upper, like a room, and then they can tell you what kind of changes you can make to modernize it. And also with landscaping, if you have a bare backyard, you can also upload a photo where they can generate multiple ideas to show you how you can make the backyard landscaping much better.
Yeah, to add to that, so we design a lot of houses too, and I love that new Redfin feature. I just click on modern or Japan or any design what I choose. And then what's interesting now is that with technology and just with websites or just with AI in general, they know exactly what you want to look for. So when you're shopping on Wayfair, they recommend vanities for you that might look good already. So it's one less thing to do, one less thinking. So everything we do is becoming easier and easier. Even finding contractors, you can make easy network online, right? Facebook, things like that. I just make one post looking for handyman, wherever, and then I can find someone right away. So technology does help a lot, social media and all that. So it's definitely make life easier.
All right, last question for you guys. What would you say would be a strategy you guys use or that you could advise everyone on how to thrive in this environment?
Thrive in this modern environment. I would say talk to Elisa, because Elisa is thriving in this environment, and just networking like this, meeting people, and finding out what they're good at. So there are people that specialize in multi-units. If I want to learn about multi-units, I want to talk to David. If I want to learn about flipping, I'll talk to Elisa. So things like that, just networking, and because there's not a lot of deals in the Bay Area. There's probably like, I don't know, 10 deals. There's how many people here? A couple hundred people here fighting for 10 deals. So we're all fighting for the same deal. So instead of competing with each other, we'll just team up. Hey, why don't we just buy together? We'll split the profit in half. That's better than kind of compete and you pay more for the house and then you end up losing money. So it's just collaboration. So that's what I love about the real estate investment world. It's a collaborative business. You can team up. We don't have to compete so much.
I think Tom has proven that being humble really goes a long way. And like Tom said, if everybody has the abundance mindset rather than just trying to compete against each other, it really helps. Like a lot of times you can share your resources. Tom actually is really good at that. Like when you share your resources, you actually get more back in some way. So, and another thing I want to talk about is really the main thing to focus on is your deal flow. If you can have really good deal flow from whatever resource that you use, is the key to really thrive in this market. And when you have the deal flow, you can afford to be more picky about your deals. So you cherry pick the best deals, and you can make sure that even the worst case scenario happens, you can still make good money.
Yeah, the last thing I would say is in this type of market, you need to have multiple strategies and paths that you can pursue. So a year or two ago, we could, as an investor, you could buy a building and say, hey, we're just gonna stabilize it and refinance it and hold it. Whereas now you have to have 2 or even 3 different strategies where if you can't get the financing that you need, or if the insurance is very difficult, then what's your plan B? You know, do you have liquidity to do a cash in refinance if the proceeds are low? Or do you have other deal flow and opportunities to just decide, hey, I'm going to sell the property and buy something else? So having multiple strategies, so that way, depending what happens throughout this year and next year, you can adjust accordingly and still be successful without being pigeonholed or forced to one strategy.
Thank you. And I think that that's a wrap for our first panel. So thank you to our panelists.
Thank you.